Welcome to Navigate Your Wealth. Thanks for joining us again this week. I'm Rebecca Powers. So happy to be the host this week with the ladies of Compass Financial, Karen Stawicki and Samantha Irish. Great to see you both.
So great to be back here with you again, Rebecca. Thank you for having us.
We've had so many calls and input and emails. We're going to get right into it. A lot of people are mostly worried about taxes.
Aren't we all?
Yes. You've taught us about diversification and all the different risks and how you can minimize your risk. Let's really focus on taxes today. What's kind of the history of the way it used to be and what it is today?
Yeah. Well, as many years as I've been in the business, Rebecca, back in the 80s and 90s, most people don't remember, but the highest tax bracket was actually 70% in 1980. I know.
70%?
70%, which is why people were anxious to put money in the 401k, because any dollar that they contributed into the 401k was directly taken off of their earned income on the tax return.
Gotcha.
The CPA said if you put money in your 401k, if you put $3,000 in your IRA, I can lower your taxes. And the CPA was doing exactly what they were hired to do, lower your taxes today. The problem is not what's happening today, but what's happening in the future.
Okay.
So 70 and 80% was the highest bracket back then. A married couple earning $100,000 a year was in the 59% bracket.
Wow.
So they deferred in the 401k, roll the clock forward today. They're pulling that money out at 25%. The plan worked great.
Now, they're still complaining because taxes feel high.
Yes.
Yeah.
But technically, taxes are on sale.
Explain that. People are calling going, she's crazy. There's no way. But explain. That's powerful stuff.
Well, think about it. If you put the money in the retirement account and you saved yourself 59 cents on every dollar, and now you're taking it out at 25%, it's on sale.
Gotcha.
But here's something I want to ask. Today, a married couple filing jointly, earning $100,000 a year, is in the 25% bracket.
Okay.
What are the chances that your income is going to drop so that you can get to the next bracket down? And do you really want to?
No.
Right?
No.
In retirement. Taxes are low. There's no chance they're staying there. Now, I am not a rocket scientist and I don't have a perfect crystal ball, but with the national debt through the roof, with the aging population that keeps finding ways to live longer, which I'm grateful for at this point. I am now very grateful for that. You have to figure out that at one point they're going to have to reckon this tax problem.
Absolutely.
And so there's, only two ways to get it. Either stop spending or raise taxes. And which of the two do you think they have the better chance of doing?
And if you've watched the news in the past few months, IRS hired 89,000 new agents. Where do you think they're going to get that from? The 700 billionaires? No. They're getting it from all of us, the regular, the middle America.
Absolutely. We have an analogy that we use, and it's called the board game analogy. Now, you've got children at home, and you're going to invite them to play a game with you. So, Rebecca, I'm going to invite you to play a game with me.
Okay.
Here's the deal. We're going to play. We're going to have so much fun. You're going to enjoy it the whole time. And then when we get to the end, I'm going to tell you the rules.
I'm not playing that game.
That's the game you're currently playing with the IRS when it comes to your taxes.
So what's the answer?
We only know what they are today.
Gotcha.
But you can be in control of where your dollars are taxed when it comes to retirement if you think about your dollars in both pre-tax dollars and after-tax dollars.
Okay.
And what she means by that is there are options that will give you tax-free income. There's only three. One is a Roth IRA. We talk a lot about that. We'll be talking a lot more about that.
Okay.
The second is tax-free municipal bonds. And the third is cash value life insurance. Now, I know cash value life insurance gets a bad rap, but truly it's a Roth IRA on steroids, and we'll talk about that at another time. But when you understand it's tax diversification, everybody talks about risk diversification, but tax diversification, and what we mean by that is this. We want you to put money in that 401k. The first rule of financial planning:
take the free money.
Take the free money. So if there's a match, I want you to contribute to that point. But we also know, and we encourage every one of our clients, that they need to be saving between 15 and 20% of their gross wages on an annual basis.
Oh, wow.
Once you've got the match on that 401k, now we want to look on the other side. This is called tax diversification. On the other side of the tax fence, where can I put that money to create a tax-free bag?
Okay.
You know, sometimes we refer to it, is it better to pay on the seed or on the harvest, right? Is it better to pay my taxes now and then be done with it? Or should I wait and let my assets continue to grow, kick the can down the road, and deal with taxes in the future? We do not know where taxes are going to be in the future, but we know that half of any number is a smaller number.
Yes.
So we have to make sure that we're not just focusing on one side of the tax discretion. We've got to focus on both. We need to make sure that we're looking at those assets to say, when does it make sense to pay the tax now versus wait?
And that is why the tax burden analysis is one of the very important pieces that you give complimentary, right?
Absolutely. Tax burden analysis is really for those individuals who are not in the accumulation phase, but you are already retired and you are looking at all of those wonderful IRAs and all of those wonderful 401ks that you have accumulated. You have saved and saved and saved, and probably many of you are trying to hold off writing that check to the very last minute. Let me tell you, this tax burden analysis is the very thing that you need to see. Call the number on the screen, 855-348-3073. When you call that number, we're going to look at all of the assets that you have, and particularly those assets that are on the board to be taxed. When you look at taking that money out over the longest period of time versus maybe paying the taxes over a shorter period of time, that's what that tax burden analysis will reveal. Is it better to rip off the Band-Aid and pay the taxes over the next couple of years? Or is it better to kick the can down the road and let the IRS get, the check is going to be smaller each year, but there's going to be more of them. And so the total tax burden analysis will reveal to you which is better, pay now or pay later. Call that number on your screen, 855-348-3073. We want to help you pay the least amount of taxes that is legally possible.
Absolutely. Stay with us. More with Karen Stewicki and Samantha Irish. Some great advice about how you can retire right. Stay with us.